Welcome back to the YouTube channel, everyone, and in this video I'm going to be breaking down what exactly is a lease option, should you be considering them within your investment portfolio, and what are the key things to be looking out for. Let's jump straight in. Before we jump in, for those that don't know me, my name is Jamie York and I've been invested in property for the better part of a decade now, and I created this YouTube channel to create, repurpose and give you as much value for free so that you can get started in your property investment journey. All I ask for in return, if you do get value, is just smash that like button and of course subscribe if you're not already subscribed to the channel. So let's jump straight in. What is a lease option? Well, a lease option is a contract. It's where you have the right but not the obligation to buy the property. So something to really take in there is you do not own the property when you take on a lease option, you control it. And what happens is you have the right to buy the property at any point within a given time frame, which you agree with the vendor or the owner of the property, but you are not obligated to buy it at any time. Sounds amazing, right? Yes, but there are some things to look out for. So there's four main things to look out for when taking on a lease option, and we'll go through this in a little bit more detail. So the first element, and most people miss these by the way, so if you're already doing lease options and you're thinking, I missed a couple of these, don't worry about it, most people do. So first of all, there's the lease part of it. So the lease part of the contracts, this enables you to manage the property on the vendor's behalf and benefit financially. Think about it as a letting agent, okay? So a letting agent, you sign an agreement with them, a management agreement, where they agree to rent out your property, they collect all of the rents, and they pay you the money from that rent minus any deductions such as their management fee. This works in the exact same way, apart from, instead of it saying we're going to charge you 10% or 12% or whatever it is plus VAT, instead the way that a lease is worded is we agree to pay you or your bank directly £200, and anything that we manage to rent it out of for above that, we get to collect the rents and benefit from that. This allows you to benefit from the profit, but also creates a liability for you. For example, let's say you agree to £200, you need to pay that on a monthly basis, whether you've got the property rented out or not. So that's definitely something to be factoring in. So the next part of this is the option. There's a reason it's called a lease option. The option part is not actually to do with property at all. It actually started in trading, where you had call and put options, which we won't go in through right now. But an option on something gives you, as the writer of the option, which the investor is the writer of the obligation, the right but not the obligation to purchase the property within a given time frame. For example, let's say I had an option on your property, a 5-year option at 100,000. What that means is at any point within that 5 years, could be 1 month from now, could be month 60, which is 5 years from now, I can buy that property from you for £100,000. Let's reverse that round. As the seller of the option, which is the vendor or the owner of the property, they have the obligation, not the right, to sell the property for 100,000. So what that means is, I know that's very weird legal wording, but what it means is, if in 5 years time the house is worth 110,000, for example, I'm going to buy that for £100,000, right? Obviously, because it's worth 110. But let's say in 5 years time it's worth 90,000, then that's probably not going to be a good idea to purchase that. So you have the right to make a decision. On the other hand, let's say it is worth 110 grand at the end and the vendor goes, hold on a second, it's worth 10 grand more than I've agreed to sell it. That's their problem. They are obligated to sell it to you at 100,000. Something else you want to bear in mind is that they're usually, and you want to make sure they're assignable. And what this means is at the end of it, you don't actually need to buy it. You can sell it on to another individual, but more on that later. The third thing you want to think about is something called the POA, and a lot of people miss this one out. It's called the power of attorney. This is going to give you a couple of different things. First of all, it's going to allow you to talk to the bank, and they'll need to send some paperwork on your behalf, because I'd much rather pay the bank directly than trust to pay the vendor and then them to pay it, because that can cause a nightmare. What it also helps with, and I know this sounds really morose, but if the vendor passes away whilst you're in contract, then you still have the rights to contract. So if they pass away and somebody else gets the property, you still have the same rights that you did with the individual, with whoever is the beneficiary of that individual's estate. The final thing, and this is going to be on maybe 10%, is an equitable charge. Now, that sounds really official. Well, it is, but a charge on a property is usually by a lender. So say, for example, a bank is lending you 75% loan to value to buy a property, they will expect a first charge on the property. So you're not going to get a first charge, and you would only really use this. What you'll get is a second charge, more than likely, by the way. But you're only really going to use this if there's built-in equity already in the property. Say, for example, there's a £100,000 property. You've agreed to buy at 100, but there's actually 20 grand equity in, i.e. there's only debt on there of £80,000. If you're going to end up buying that property for 80,000, sorry, let's say, but it's worth 100, then there's going to be 20,000 in there, right? This doesn't happen that often because most people are selling their property or doing a lease option on a property because they're in negative equity, but you'll be shocked. So there's a lot of different reasons for it, which I'll go through momentarily, but what you want to do if there is equity in there is protect it, because even though you've got this lease option contract, if a vendor decides, actually, see you later, I'm going to go elsewhere, you want to make sure you're protected in the best way possible. So it's going to depend on the lender. Some lenders just won't allow for it. So check in with the bank and make sure they allow for that second charge to take place. Okay, so when you're doing a lease option, there needs to be, and you want to write this down, consideration. For anything to be legally binding within this contract, there has to be consideration. What this means is, that was awful, there has to be money. Okay? Can we see that okay on the camera? Yeah, we can. There has to be money. So if you've ever heard somebody saying something like, you can buy how to buy a house for £1, you cannot buy a house for £1. Well, I mean, in extreme circumstances maybe, but no, it's not actually buying a house for £1. What they're talking about is the lease option, okay? Now, there has to be an exchange of value. A majority of the time, it is £1, and you want to prove that by sending it to the bank account, and it makes the contracts legally binding. I know it is utterly ridiculous having the thought process of putting £1 in, but it really does make a big difference to the validity of the contract. So definitely something to make sure you're doing. Next thing is making sure that the banks know and getting consent to let. So a lot of people get this wrong. So, okay, first of all, letting the banks know. People are just like, try and get away with it. Don't bother telling them. Okay, you are voiding somebody's contract. So it might not be your contract you're deliberately voiding, but it will be their contract with the mortgage company. And technically speaking, and I'll be upfront, I've never seen a bank pull it, but that doesn't mean it doesn't happen. If the bank finds out that there's some form of lease option and somebody's got a consideration to buy this property and you haven't told them, a lot of the bank's lending criteria will be null and void. So technically speaking, they could just go, no, we're going to pull the money from you. So I'd always get in touch with the bank, let them know what you're doing so that everything is above board. Likewise with consent to let. Now, for a buy-to-let property, you obviously have consent to let already because they're buy-to-let mortgages. But a lot of lease options that you'll end up taking on will be basic residential mortgages on properties that are in negative equity, probably from the 2007, 2008 crash, which is fine. But you will have your insurance voided as a buy-to-let landlord if you don't have consent to let on the property. So that for me is a black and white one. If you cannot get consent to let on the property, don't go anywhere near it. Obviously, if it's a buy-to-let already and it's got a buy-to-let mortgage, then you're fine. But just make sure you've seen the paperwork for that, because if something, God forbid, does go wrong with the property, or a tenant or somebody hurts themselves in it and you haven't got the right insurance, which you won't, because even if you've paid for it, it will be void, you can get sued. And there's a lot of things within property that's a prisonable offence. So a lot of people doing lease options don't talk about consent to let, but it is a huge no of going forward with a property without that in place. Next is the exit of the property. So I'm just going to wipe this off and start again from now. And we're going to look at the exit of this. Now, I know this sounds a little bit weird, but every investment that I'm going in, I'm thinking about the exit. Now, I'm a legacy builder within property investment. What that means is my exit for most of my investments is death. I know that sounds so morose, but I'm not looking to get out of a majority of my investments. It's why I don't really care about the current state of the economy for me buying, because as long as a property reaches my criteria, I know over the long term there's a limited supply of property, especially in England, the small island that we're on the UK, and a huge growing demand for it, okay? So with the exit of lease options in particular, that's where you're really going to make your money. So there's a few different ways. In fact, there's 4 different ways. So number 1 is you buy the property. Now, the thing to be thinking about this exit is, how are you going to buy the property? So technically speaking, you'll probably not come across any problems, but also in the small print of a lot of mortgages, if you already had some form of consideration previously or prior, it's going to be hard to get a mortgage in place. So just something to bear in mind, that if you are being open with your mortgage purchaser, then you might come across some complications at the end when you're trying to buy with mortgage. Most trainers don't tell you that, because I don't think most of them actually know, if I'm completely honest. So a bulletproof way of buying these at the end is 2 ways. Either buying with cash and then refinancing within, you can people talk about 6 months, but you don't. You can refinance the next day if you want. Or buying with bridging if you don't have the cash, and then refinancing. Just something to take account of. Will you be able to get around it and buy with mortgage? Probably. Are you dealing in the grey area? Probably. So if you want the bulletproof way, always factor in your figures based on buying with cash at the end or bridging. The next one is expiration. So if, for example, you get to the end of the term, let's go with our 100 grand property. I've got an option on this property for 100,000, and I get to the end of the 5-year period, and you know what, it's only worth £90,000, then what I could do is just let it expire. I.e., I'm not going to buy the property, here's the keys back at the end. This is why it's such a great investment tool as the investor rather than from the vendor. So you're de-risked at that point. But it is important in the meantime to acknowledge that you do need to make those monthly payments on the option. That is a legal obligation. It's just also nice to know that you can have that exit as a worst case situation. It's why with lease options, I always say to make sure you're working out the deal based on the cash flow that you're getting, and buying it at the end is just a nice bonus, but it is not conditional on that to make it a viable investment to me. Next is extension. So what you can do is, there's no hard fire way of doing a lease option. If you get to the end of the term and it's not going to work, so you might expire the option, some other option I'd be saying to the vendor is, well, look, how long do you have left on your mortgage? So it might be that you've done it to the max term already, which is 21 years, absolute max you could do a lease option for. Another video on that down the line. But let's say you've done 5 years and there's actually 10 years left on the mortgage. Well, technically speaking, you could extend for another 5 years. So I'd be saying, hey, Mr. Mrs. Vendor, look, we either need to hand the property back, or would you be interested in extending the option? A lot of vendors will extend it for you, okay? Because the last thing they want back is the headache of the property and remembering all of the reasons that they gave it to you in the first place. The other thing to consider is if it is within 1 or 2 years of the actual mortgage expiring, a lot of mortgage companies will allow you to extend. We've done it with a lot. There are some that won't, especially some of the older, the subprime lenders back in the day. But a lot of them, if you get in touch with them and say, hey, look, the mortgage is going to run out this year, could we look at extending it? It's not worth it. It's still in negative equity, but we want to carry on paying the money. A lot of them will extend it from between 3 and 7 years, something to be aware of that most people don't know about. The final thing that you could look at is assigning the property. So this is a little golden nugget with lease options, is actually you don't need to buy it yourself. Let's say at the end of the term, you've got the option at 100,000, but you think you can sell it for 110,000. You're thinking, yeah, it's a decent property, but it's vacant. The tenant's moved out now. I'm going to have to do a little tar up and all of that to get the tenant back in. I don't really want to buy it myself. What you can do is put it on the open market. You can have people go round and buy it for 110,000, let's say. You put no money into the property. The buyer buys it for 110. 100 goes to the vendor as agreed, and you get a nice chunk, £10,000 in your pocket to walk away with. Not a bad exit. So a lot of people ask me, why would a vendor enter into this agreement? Well, I understand why you'd be asking that question, because let's be frank about it. It's way in favor of the investor, and it's pretty shitty, if I'm honest, for the vendor. It's basically, look, I'll take a problem off your hands, and I may or may not buy it down the line, but we'll see what happens with the market. If it's in my benefit, I will, and if it's not, that's your problem to deal with. It's not great, okay? But there's a lot of reasons. The majority of it is negative equity, okay? These are tired landlords. You have to bear in mind that you coming into the market going, yeah, I want to get into property. I want to build a portfolio. I've got the time, the energy, a bit of money. I want to learn on the job. That's great for you. Try thinking like that and having that energy in 30, 40 years' time when something's gone wrong in the market. Because that's what a lot of these people have done. They got roped into the market at the height of the market. They paid way over the odds for the property. They were massively overexposed. These are when mortgages would pay like 110% of market value for a refurb. And they were doing that on new builds, right? There's no works to do. And so they were overexposed. They had a couple of nightmare tenants, and actually they just want away with the headache. A lot of these people, they've got a portfolio of properties. Maybe they've got some great ones, and they just want away with the mutts of the litter or the runts of the litter and make that somebody else's problem. But this is the same as everyone else. Same as why would somebody sell a property below the market value? Well, it's all situational down to the individual. So there are a lot of situations, and remember that as property investors, we're looking for problems, okay? Because if we can go in with a solution-focused mindset, i.e. being a solution provider to somebody's problem, then you're going to be able to get these deals. So yes, there are a lot of opportunities. Yes, you should definitely take advantage of them. But my overall opinion to sign off on this video is always be careful. Now, whilst it is in your benefit, what I've seen with a lot of newbie property investors is just because you can, you should mentality. And actually, no, there are plenty of opportunities to take on a lease option. And after spending time assessing the deal, I can say this, hand on heart, the best deals I've ever done in property are the ones I didn't do. And sometimes within investment, the best investments you'll ever make are the ones you walked away from. Just because you can do a lease option on a property doesn't mean you should. And I've seen it way too often. People going, yeah, I've got this great lease option opportunity. It's like, yeah, but it needs $8,000 spent on it. The last 3 tenants have trashed it. The area is awful. And they go, yeah, but I got it for £1. It's like, you didn't. You signed up for a 5-year obligation paying £200 a month on a property that you'd probably break even on in year 4. So that's just something to factor in before you throw yourself at this opportunity. So should you do lease options? Absolutely, 100% yes. I think every investor should look to have it as part of their portfolio. However, don't just jump in on every opportunity you see. So they're just my thoughts on what a lease option is, what you need to look out for, and the contracts you need to make sure you've got. But what I'm really interested in is your opinion. So have you tried lease options? What did I miss in this video? What do you look out for when you're making your next property investment? Let me know in the comments and I'll try to reply to as many as possible. And hey, if you're new to the channel, it would help me immensely if you hit the like button for the YouTube algorithm. And of course, if you want to see more videos, make sure to subscribe, hit the notification bell, and hey, whilst you're here, why not watch the next video coming up?